I've been thinking about this a lot because it gets a little deep. It gets a little deep for me, and I'm trying to figure out how to explain things properly. So the thing that keeps coming into my mind is, in order for the industry to progress, there's all kinds of things, right? There's costs coming down, portfolio management costs coming down, which ends up in investors' pockets, assuming that the gross results are still just as good as prior to the fee decrease. There's all of these small independent pieces to the puzzle in the financial services world that lead to it getting better and better. But there's this big overarching thing that just keeps coming up as the core way to describe this, which is, it became very obvious to me when I first launched my practice that you needed to work cooperatively, systematically and cooperatively with other professionals that make up the financial planning, the entire financial planning team. So, if you look at all there's so many things that come into play where it's not good enough to just say, hey, I've got a CPA or an accountant that does my tax work, tax planning and tax work. I've got a financial advisor that does investment management and financial planning work. And I've got an attorney that did my will and trust, so on and so forth. A lot of people have that team. The progression in the space, what we've built, the reason why we believe what we've done is revolutionary and that it's the new model, the new general model for financial services, is it just became really obvious there needed to be a cooperative, systematic approach to getting all of these professionals together and all of the information flowing properly, so that the actual planning items that can bring measurable value can legitimately get implemented into the client's world. That's where everything falls apart. There's all these coordination gaps. Nobody knows. The left hand doesn't know what the right hand is doing. Just there's simple examples like just when an estate plan gets created. When an estate plan gets created and all the assets need to be retitled and the beneficiaries need to be changed, that hardly ever gets done. In this model, that gets done. That's part of the process, is that the team of people, there's a responsibility to make sure that actual full thing gets done. Think about how crazy it is. It's absolutely nuts that a large percentage, we're talking 80% of people that pay to get living trust any type of trust created. They never get implemented. The assets don't get retitled into the trust name. Beneficiary designations don't get changed to the trust. What happens normally in the current model before we changed it is just absolute insanity. It makes no sense. There's all of these areas where everything needs to be coordinated properly and fully implemented so that, again, the client actually gets the value into their world that they think that they're getting. So the list goes on and on of these coordination gaps that exist when you don't have all of these professionals with transparency on somebody that understands the whole. When you don't have transparency across the board and you don't have, let's say, guaranteed execution, or maybe guaranteed is not the best word, when you don't have a party that understands what has to happen as a whole, that makes sure that the entire thing gets done. The trust gets prepared, the assets get retitled in the name of trust, beneficiaries of IRAs, annuities, life insurance accounts, etc. get changed. There's so many examples where the tax planning and investment management world meet. So there's simple examples like this tax preparation services and financial advisory firms. The client does a 60-day rollover. In other words, takes money into their own possession out of an IRA, but puts it back in within 60 days. So when that occurs, the 1099 that comes from the custodial, the IRA custodian, it just shows that they took the money out. There's nothing happens at the custodian when you put the money back in within 60 days. they still issue the 1099. They don't take, the custodian essentially doesn't take responsibility for whether or not you put the money back in. That's an honor system between you and the IRS. So when financial advisor does that transaction, gets the money out of the IRA account for the client, gets it back in within 60 days so they can down payment on a house, well, this kind of stuff happens all the time. Well, when the tax preparer, when everybody in this pool of professionals, tax, accounting, insurance, investment, estate, across the board, when all these professionals stay siloed and do their own thing, it's crazy to think about it. It doesn't matter what example you use, a basketball team, anything. There has to be this extreme amount of communication between the coaches calling plays, between the players communicating, switching on defense. There's all of these things. There's constant need for communication. The better communication equal better results. So for whatever reason, in our world where the clients want their money to grow as fast as possible with the least amount of risk. They want to pay the least amount of taxes within the rule set. They want their assets to pass on to their heirs in the manner in which they desire. They have all these. The average family, the average person, has very, very similar goals. There's differences, and people's situations are different. Their income levels are different. Their asset levels are different. There's lots of differences, but the core drivers of behavior, the core, let's say, wants and desires, they're very, very similar. So, for example, in the tax world, you have people that will bend the rules in the tax world. If they think they can get away with it, they'll actually bend the rules to give the government less money. Then you have people that, which is the majority. The majority of people, it's really simple. Do whatever needs to be done in my entire world so that I pay the least amount of tax humanly possible within the rule set. Don't break the rules. Just whatever I can take advantage of, I want to take advantage of all of those things. I don't want to pay capital gain taxes on the growth of my investments if it can be avoided. I don't want to pay taxes on interest income for my portfolio if it can be avoided. All of these various things, right? Now there's obviously details like in the interest example, we all know we can avoid taxation with municipal bonds. Client has to be in a high enough marginal bracket for it to make sense. But the point is that every person that has money that I've ever talked to, if I talk to them about taxable bonds versus tax-free municipal bonds, they just want to know, how do you figure out which one's the best for me? If I'm in a high enough bracket and you do the tax equivalent yield calculation and munis are better, well, let's go, right? So that's the way that people think. In the estate planning world, some other great examples. Most people fall into a couple of categories. After you talk to hundreds of people about what they want to happen, they actually have to think about it. All right, I got a few $1 million, whatever amount of money they have. What do I want to do between now and when I die? And what do I want to happen for my kids or my grandkids or whoever's going to get the money? And on average, there's all kinds of variations, but there's two extremely common. One is they go, well, I don't plan to do anything that's not beneficial for us, for me and the spouse or whoever it is. I don't want to do any planning that enhances the size of the estate that the heirs are going to receive. I don't want to do any of that it has a negative impact on us right now. Some examples of that you could take, like life insurance planning. If you look at certain people, do they owe, is their estate large enough where federal estate tax could be due, yes or no? All these details. But there's possibilities, significant leverage where you can take life insurance death benefit proceeds, pay off to beneficiaries in an estate tax, let's say usually free manner, income tax free manner, if things are done right. So where I'm going with that is you have to pay a premium, right? You have to pay an insurance company a premium to buy that policy, which comes from cash flow now. Might be the best overall planning for 2 or more generations, but a lot of people, the first generation, will just say, I'm not going to, whatever's left, the family gets, and we're going to do our thing, and we're going to grow our assets and use income from our assets and do our thing, And then whatever's left over, we want these people to get the dollars, and this is how we want it to go. And we don't want to give the government any money that we don't have to. If we owe some, estate taxes or whatever, fine. But we would do planning to reduce the estate taxes as long as it doesn't, reduce our spending capabilities or have a negative impact on us now. And there's a lot of things like that where the next generation can benefit significantly by planning done now, which doesn't negatively impact the current generation. And and then there is this other category that does a lot of things to enhance the size of the pool of wealth for the family as it passes down from one generation to the next. So there's a lot of families that they look at it differently. They go, no, we're going to actually kind of look at this almost like a business of growing this these family assets as a business, and we'll create a family office, and there's these different ways of doing things. But either way, got off track there a little bit. Family office, got off on a side road. Can't remember exactly where I was going, but it doesn't matter. Circle back around here. So in that example where you have the second bucket of clients or people that will do things while they're living to grow this wealth of the business, the family business almost becomes their wealth, and they do lots of stuff that is time consuming for them, that reduces the usefulness of the assets while they're alive, so that they can continue to grow this family wealth business into future generations. So some are pro that, some are, I'm not going to spend time and energy. There's a lot of money here. They can do what they want, after they get it, and they're not going to turn it into this big organized business thing that passes on from one generation to the next. So there's so many things that are similar across the board when you talk to human beings. There's so many similarities. So if you really tried to break it down, it's like there's all these players in this game, and we're in this rule set, right? So if you picture picture the people in the U.S. We're all the 330 million or whatever people in the U.S. We all have the same tax code. We all have the same estate planning rules and legal system and all that stuff. But playing that game is different for some people versus others. And a lot of it comes down to how well informed those people are of that rule set so that they can take advantage of the rule set. So if you don't understand how the game works, if you don't understand the rule set of the game, it's really, really hard to have an advantage in the game. So that's kind of a gamified, game theory, kind of simplified way to look at all of this from a client perspective, is that the end clients, even though there's lots of differences, but there's also this huge amount of fundamental similarity. It's almost like everybody's got the same canvas that they start with, but then there are these adjustments. But that canvas, or that fundamental layer for the clients, for the people, is they're players in this game of which there's a rule set, and they want to take advantage of that rule set to benefit them, and sometimes to benefit others, right? So you have some players in that game that will do more things that benefit others. A lot of times, in that example, they also benefit by the feeling of being charitable, right? So it's kind of an interesting thought, but whether a person is motivated to feel good about giving to others, or they only feel good about getting more for themselves, there's still this rule set that they either are informed of the rule set or are not, and know how to play the game or don't know how to play the game. And so everybody really wants to know what they can do, use that rule set to their advantage, use that rule set to other players in the game that they would like to help as well, organizations that they like, other family members, whatever the case may be. But at the end of the day, almost everybody wants that. I haven't met anybody yet that doesn't want to maximize the efficiency of the use of this rule system, of this game, the rules within this game that they're playing. Really, everybody does. Now, differences in where that energy goes, right, to benefit others more versus themselves, or vice versa. So, all of these different iterations, but when coming to the realization that there is this, there are a huge amount of similarities, or this huge correlation on the desires, the core underlying desires that human beings have when it comes to financial services. I'm calling this whole thing financial services. Okay, so to me, estate planning attorneys, accounting firms, legal firms, insurance firms, investment management firms, financial planning firms, and all of that entire space that I'm throwing that all into the bucket of financial services. That's the way my brain works. And the reason why is because if you look at it from the perspective of the family, of the end person with the capital, with the assets, so this is a core thing to understand as well. When you look at this and think about this, this came as a result of being a financial advisor and organizing assets in systems like e-money. So in doing that and working with accounting firms and legal firms, just this light bulb goes off, which is the assets themselves, all of the owned assets. These are all things: capital assets, life insurance assets, real assets, stuff that doesn't have title, like gold sitting in a safe in a basement. But all of these assets that people, company, families own, they all have the potential to be taxed as they grow. Okay? They all have the potential so all of these things, all of these assets that we hold, if we think about that relationship with our assets, so from the holder of the assets perspective, this all looks like one big thing that needs to come together and be done properly, because this one big thing is simply, I've got these assets, and when it comes time to do my tax return, whoever's doing my tax return, I want to make sure that I pay the least amount of taxes within the rule set. So think about just a simple concept like the tax loss harvesting concept. When you think about that concept, it's really interesting. There's a little loophole. The little loophole that we all do as financial advisors that implement these kinds of strategies is we sell securities that can create a loss on paper, and then we buy back a security immediately after. It's got a really, really high correlation to the securities that we just sold. In other words, like a 99% correlation. So we create the loss on paper. We buy something back that's equivalently the same, and then 31 days later, we buy back the original position that we sold so that we have exactly what we want in the portfolio, and everybody wins. So we create these losses on paper. We then use those losses to offset gains. Now, for the average person that doesn't understand how huge that is, if this is done right, okay, when this is done right, most people that have wealth have large non-qualified accounts. So they have IRA, pre-tax monies, Roth IRAs, etc. But when you get people that have $1 million and up, you start to see these large non-IRA, non-qualified accounts, because you can only get so much money into these pre-tax and IRA, Roth IRA, 401k, 403b, cash balance. You can only get so much money into these plans on a tax deductible on a tax basis. So we can only get so much money into these plans, right? So then people that have a significant amount of wealth typically have these larger accounts that are just not IRAs, they're just regular money. Well, in those accounts, we have to pay taxes on dividends that are paid from stocks. We have to pay taxes on interest income from bonds. And we have to pay taxes on, hopefully we don't hold mutual funds in those accounts as an example, because then we have to pay unneeded capital gain distribution taxes, long story, but we could pay capital gain taxes on actual barter transactions, not transactions inside of a fund, but we actually sell a stock, a bond, a mutual fund, an ETF, whatever. So we sell something, creates a gain, we have to pay whatever, depending on where we're at. Could be 0, could be 15, could be 20. So we're going to pay some capital gain, long or short-term capital gains rate. Okay, so that being said, the tax loss harvesting thing is so huge because when that's done right, what it really allows us to do is it gives us this room. We have this breathing room now where we have these losses that were created on paper to offset gains. The gains that we want to offset, if you think about that deeper, those gains that we want to offset are a result of this. We're managing a portfolio and we want to make changes. We want to sell positions that are up significantly at certain times. There's portfolio management activities that we want to do in those non-qualified accounts, and we don't want to pay capital gains tax. We want to make the change, but we don't want to pay tax. So the way to do that is we create the losses on paper. It's called tax loss harvesting. That gives us the ability for the entire life with that account to get that account really, really close to target, to be able to sell things we want to sell and create gains because we got the losses to offset them, and we do that consistently throughout the life of the account. And what ends up happening is we pay some taxes on the interest income, which is not a lot. We pay some taxes on dividend income that we probably spend, but we never pay, on average, if it's done right, we never pay a penny of capital gain tax throughout the whole life of the account. There were capital gains created, but we didn't pay any tax because we offset it with losses that we created on paper with tax loss harvesting techniques. So then, when the person passes away, there's this rule in the system called stepped up cost basis. So to implement that rule at its finest, we want to be able to take all the unrealized gains that are in this account, this fictitious account that I'm discussing right now. We want to be able to take all of the gains that are left in the account, and we don't want to pay taxes on those either. See, there's going to be positions in the account that we never sold. So we create gains frequently on an annual basis. We create gains. We offset them by the losses, but we create those gains because we want to sell something that's at a gain. We want to sell it. But there's always stuff that we just don't want to sell. And so we end up having this wonderful system, which is really tax loss harvesting technique offsets all gains as we adjust the portfolio and sell as we want and manage that portfolio as we want for the whole life of the account. And as there's positions that grow over time that have unrealized gains that we still hold in the account at the time of death of the account holder. When that occurs, we get a stepped up cost basis to the date of death value. Wonderful planning technique for the family, saves a huge amount in income taxation. So for those types of techniques, number one, there's coordination needed between the professionals to make all that actually work in real life. It's a concept that's pretty easy for people to understand, but to implement it in real life in a person's entire financial situation is not actually easy. Well, we do it. It's not easy, but we do it every day. So what's really the reason I call this whole world, accounting, estate, insurance, investment management, financial planning, that whole world, I put it into one big lump sum category of financial services because of this. From the client's perspective, they want their money to grow. In that example I just gave, they want their money to grow as much as humanly possible and pay the least amount of taxes. Okay? So they also want to make sure that their tax return is prepared properly and that there's not something that's unknown by the tax preparer or the accountant or CPA that they lose out on the ability to take a deduction or reduce their tax liability because there wasn't coordination amongst the team. So everybody wants that core fundamental efficiency out of their life, out of the income that they make and the growth of their assets. That's just a universal thing that the humans want. Okay, so when all the humans want this, when everybody wants this, then that puts us in a position that from their perspective, they don't care what we call the person. Oh, that's the estate attorney. Okay, well, what do? Well, they make sure that all these assets, that if I were to die or become incapacitated, that the right people get it, and that the government gets their grimy hands off of it and only gets what they deserve within the rule set. So I want to make sure that all that's done right. I want to make sure that I don't have to pay probate expenses if I can avoid it. Well, in order for that to happen in real life, you can't just create an estate document. The estate document has to be created. All the assets and beneficiary designated assets, everything has to be changed. And then ongoing, as people buy real estate and open new bank accounts and open new brokerage accounts and do all those things, it has to continue to be done perfectly. So a system like ours allows all of those needed details that are actually required for any of this to work. Think about that. None of this stuff actually works. I see this in business every day, with software vendors that we work with across the board, where you're just like, hey, we didn't do that last part. And none of this works unless we actually do that last part. And that's what happens in the financial services industry in general, in the old model. That's what it looks like in the old model. It's this siloed, fragmented, all these coordination gaps exist. And at the end of the day, in that example of getting an estate plan, a trust, wills, trust, powers of attorney created, in the current model, on average, the documents get paid for. The law firm collects the fees to do the estate plan, but it doesn't get executed and implemented. The assets don't get titled properly. The beneficiaries don't get changed properly. The whole thing, that's what people don't realize. It's not kind of an issue. The whole thing does not work. None of it works if the funding or the asset titling and beneficiary designation part doesn't get completed. So sometimes people that's a really important thing to make sure that it gets clarified when these kind of things are being taught. Is it's not that it's kind of important. It's that it doesn't work at all. 0% of the benefits occur if that last part doesn't get done. Think about it. That's the reality in the industry right now, is that's more common, that an estate plan gets created and no benefit occurs for the family. The trust, to keep it simple, the trust never gets funded or half funded or whatever the case. It's just so, it's an absolutely amazing, just mind-boggling thing when you really think about that. The old model, that's how it works. And people think the reason it's not on the front page of the newspaper, because by the time the heirs take over and try to clean up the mess and get everything taken care of, they don't know the whole history. They don't know. To them, it's like everybody's pointing fingers at each other. Why didn't you do it? Why didn't you do it? I mean, that's the way. That's what this has come to. Is it's just becomes like lack of responsibility for any party to make sure that the family or the people doing the planning, the investment management work, the estate planning work, the tax work, whatever, that it actually gets executed and works right. So it's a little crazy, but that's the old model. So the new model, what we've built, why this is such a revolutionary platform, and why I call it Financial Services 2.0, is because we fixed that issue. People that work with Revisor. So any in family that works with a financial advisor that uses our new platform, let's call it. Anybody that is plugged in to our platform is able to solve all of these problems. They're able to actually implement all of this stuff with measurable value. We're about to publish this paper right now. What I'm going to cite is an original paper written by Vanguard. I don't remember the authors' names. There were several authors, but it was great. It's probably the most read piece of work by financial advisors. It's unbelievable. It's called Advisors Alpha. And it's essentially, they did such a great job. The writers of that article, I want to meet them. They did such a great job of, number one, just having the intuition or having the intellect, the foresight to think about all these things and break it down to a basis point value that's created. That was just awesome. That's the language we speak. It standardizes the value. We like to standardize, so that was awesome. But it brought this new mindset of all of these things that we do have measurable value. And if you're not informed and nobody helps you do it, you don't get to take advantage of the rule set. You don't get the value. So That article's phenomenal, and we're doing our version of that, what Vanguard initially did. Our version is taking what they did, we want to recalculate everything they calculated, but also add in all of these additional planning techniques. So there's so many things. Doing QCDs from your IRA account, backdoor Roth contributions, the list of things that don't pertain to every person, but some of them pertain to everybody that has assets and has income. Okay, so that when that article drops, the being able to get a measurable value that's legit and makes sense for each planning technique, a measurable value compared to their invested assets or their net worth, whichever way you want to look at it. We've got it all. We're going to have it all covered. It's just absolutely phenomenal. These are all things. These are all things that we can do within this world of these various professionals and various services. These are all things that we can actually implement and execute where we have measurable value. This new system actually takes advantage of the rule set that's here for everybody. In the old model, people are doing things, but they're not actually taking advantage of the rule set, or at least not a large percentage of it, because everything is not brought together properly in a cooperative manner to actually execute and implement the needed items. It never happens. It's a very interesting thing. So Revisor Model Financial Services 2.0 is a cooperative model of bringing all of this together in a transparent model, in a transparent system where all of these professionals work together and the information flows properly. And last but not least, there's a responsible party for the execution of all the things and accountability for the execution of all of the planning techniques that pertain to a particular family or individual. So that's what makes this so awesome. It's a cool story, in my opinion, because the word cooperation kept coming into my mind. Cooperation. And in my opinion, when you look at just everything going on the earth today, whether it's in my case, financial services is what I eat and breathe every day. So I'm looking at it from a financial services perspective, and when you look at these huge problems and try to solve them, at the very end of that thought experiment is cooperation. There's got to be a cooperative movement towards the whole coming together. And that's what we've been missing in the field. That's what we've brought together under one digital or physical roof, however you want to view it. Investment management, financial planning, tax prep and accounting, estate planning, and insurance services all together with accountability, transparency, and cooperation. It's absolutely amazing. Here we come.